Welcome everyone, this is Thomas from TradeWin. In this video, I will try to share with you a simple trend following system that beats the overall index via the buy and hold strategy. So in this specific playlist, you will find my personal studies that I'm sharing with you in order to build my all-weather trading system. An all-weather trading system is according to legendary Tom Basso, who was a portfolio manager for Transtat Capital Management in the USA for the past 50 years, I guess. And this guy showed that having different strategies for different market conditions was the best thing to manage a whole portfolio. And for that, the key component was trend following systems. So I want in this video share that with you. For those of you who don't know me yet, my mission is to debunk the lies we are told by our favorite YouTubers or even financial advisors in order to debunk them. I want to empower traders with professional level data so that you could make informed decisions. And I do that mainly using my incredible backtesting technology. So in this video, I will redefine what buy and hold strategy is. You may know that, what dollar cost averaging is. And finally, the most important thing will be my presentation of the simple trend following system I have built in quite a few days, really easily. So let's go. Buy and hold strategy. So we can all think that we are more intelligent, more accurate, more everything that our neighbor. That's why we'll think that when trading will be better than the ones who just buy and hold index funds. Because we are convinced that spending enough time studying the markets, hiring people, taking YouTube lessons, going into mentorship with YouTubers, etc., will make us beat the market. That's, I'll say, a dream that everyone thinks he could achieve one day, but reality is much more, I would say, harsh, and people finally come back after losing some significant amount of their money to buying and holding index funds. Okay, so you understood what buy and hold is about. It's about buying an asset and holding the position forever. So you could find so many advantages of this kind of strategy on the internet. Among them, capital appreciation over time, tax benefits, and compound interest. However, the risks are really high, and because the downside direction of the market could really crush your entire portfolio for real. It's a full risk investment. There is no stop loss. Stop loss refers to the fact of setting at a level at which you will invalidate your first assumption of being long, meaning you think the price will go up. And there are also lots of psychological challenges of patience, which are really difficult to deal with. So you could find that on the internet. So for the example, let's take, for example, Apple. Everyone knows Apple. Everyone dreams of owning Apple. So it has been, a huge portion of each of the US indexes. So let's have a look at its specific chart. So that's Apple since 2002. You can have a look at that for free on TradingView. So what's the idea? The idea, if you buy at any time, even at the top of any cycle, I will say, buy hold strategy says that you are guaranteed that if you wait enough, you will see price go up and absolutely shoot above your entry price. Okay, so even if you buy here at any top here, holding forever will make you profitable. Okay, so that's the theory and it's true. Okay, so this is really important. That's true. Holding forever is profitable because of inflation, because of our governments printing money. $1 today is an absolute joke of what was $1 100 years ago. Okay, you can find those stats on the internet. But because you are, yes, humans, we can't deal with short-term panic. For example, I summed up here some of the Apple bad years performance, and we can see that quite quickly you can see most of your investment going down and going real down. So these are the kinds of drops, market drops I'm talking about concerning Apple, and I doubt any one of you is strong enough to just close the eyes, don't watch the portfolio, and don't do anything to absorb the loss. Okay, most of you, and it's normal, will want to get out of the position to protect what's left from the capital you initially had. Okay, Apple was a specific stock, but when we hear more about, I would say, buy and hold strategy, we more think about indexes. So let's have a look at the Nasdaq 100 index. And here, again, on TradingView, we can see that there are lots of periods with huge drops. And especially, for example, if we have a look here at the 2000 bubble, tech bubble, it took for Nasdaq more than 16 years, close to 17 years to break even. So imagine one moment you are here thinking, okay, it will always go up. I'm just going all in. I buy everything I can of Nasdaq and let's see what future brings. A few months later, you are like 82% down. That's the biggest drop we ever witnessed on an index. And if you still hold the position, it will take 17 years to break even. And most of you, and I'm quite sure about that, no one buying there just will wait during all this time until the stock goes up from the entry price. Okay, and that's normal. Again, you have the 2008 crash, many other downturn, I would say, crashes. Some of them, as the COVID one, was really sharp in a few days. Other ones are, I would say, more, takes longer. Okay, that's the 2022 downturn market we had. Okay. But each time, what we can see is that we always go back to the initial investment, okay? So that's the buy and hold strategy, okay? So let's take an example to make sure you understand that. Example, today is 12th of February, 2024. S&P 500 is at all-time highs at 5,000 a share. Let's say you have 10,000 aside and you want to do buy and hold strategy from now. You could buy 2 shares of the S&P index, okay, with $10,000. But now let's imagine that, and you don't think it's a good strategy to just go all in at a specific time. You want to take and to set a stop loss, and you want to go with limited risk. Okay, let's say 10% of your whole capital, $1,000. You could buy, risking only 1,000, a position that would be much bigger than the one you would have bought with buy and hold strategy. Okay, so that's just a way to show you that here you are assuming that you are okay with S&P going back to zero, going 100% risk. That's what you do when you do buy and hold. You don't have any stop loss. But the probability of this index to go to zero is really low. And you can't assume that, okay? that it will happen. So the idea is to set and to implement a strategy using stop losses to minimize your risk first and to take leveraged positions. Okay? So that was the first idea about buy and hold. Let's continue with dollar cost averaging. Okay? So according to what we saw in the previous charts, dollar cost averaging is quite different from buy and hold. The idea is just to buy at regular times, okay, the same amount of fixed dollar into the asset, okay, whatever the, I would say, the market conditions are. For example, I don't know, you are paid in your job every month. The idea will be to put a certain percentage of your income directly into index funds, whatever the market conditions are. That's what dollar cost averaging is about. Okay. Example, you can fix that to $100. You could fix that to $100 of Nasdaq every month. Okay. Over buy and hold, the main advantage is to prevent bad timing. Why do I say that? Bad timing. Remember this chart. If you are a really bad timer, and you can choose that, imagine you go all in at this specific point, okay, or even at any top you can see on the chart, okay? It's bad timing to just go all in. That's what you do with buy and hold strategy, to go all in at one specific time, okay? So the idea is to end up investing much more, but on a regular basis. That's the idea of dollar cost averages, okay? However, because this is meant to lower your risk, this also reduces the potential profits you could make from this strategy. Most people say that you will find on the internet that you have higher transaction costs. Well, we are in an era where you can buy CFDs or shares at almost zero commissions, okay, for whatever broker you are using. So, I mean, this is not the case anymore about high transaction costs. So now, after this quick introduction, let's get into what you have been waiting for. I have teasing this, the simple trading following strategy. Why do I focus on trend following? The reality, and only few people will tell you that, trend followers are the ones who make money long term, not day traders. Okay, that's a fact. I have read many books about that, especially one in which it was said that the guy, his name is Dr. Van Thorpe, okay, Van K. Thorpe. This guy just interviewed hundreds of people, hundreds of successful traders, and wanted to know what really makes a trader successful. So after interviewing 100 of them, he was with facts, and he analyzed his data, and he came up to that what really, I would say, make traders successful is a trading strategy they believe in, okay? Because you don't trade the markets, in fact, you trade the beliefs you have on the markets, and most of them were trend followers. That's really important. If YouTube was here, I will say 20 years ago, I mean it was, YouTube went live in 2005. If YouTube was there, I don't know, 50 years ago, maybe we would have some evidence that people that called them day traders, making videos, making thousands of dollars, showing you cars and the dream lifestyle we all want, in fact, are not successful long term. Okay. I also recommend for you the All-Weather Trader by Tom Basso, where he defines and explains what the trend follower thinking is, and giving a lot of practical examples of how he trades. I've never found any portfolio manager who shares this way his experiments, his specific strategy with precise parameters. So that's really an important piece, I will say, of documentation you should have a look at. So if you want to be rich, and I hope you are, day trading might not be the best way to go long term. That's why you absolutely need something that's called a trend following system. What are Bollinger Bands? Bollinger Bands are bands wrapping price action. There is a middle band, one upper and one lower band. Okay? So I always take an example to be more clear. If I take the S&P 500 graph, and here is the Bollinger Bands. So in orange you have the 21-day, I would say, simple moving average. Okay, you can easily find an indicator showing you that, and as a reminder, TradingView is free. And you have here two bands, the lower and the upper. The upper band is one standard deviation away from the middle band, and the lower band is again one standard deviation away. Okay, so there is a kind of band. That's why they are called Bollinger. Bollinger bands. Bollinger is the guy who invented that concept, and the idea is to wrap around inside these bands kind of market noise. Most people use this band differently. They consider that when we are at the bottom of the band, it means that we are oversold, and that it might be an indication that we might get long. Okay? And when we are here topping the upper band, it means that we are overbought and that we might consider selling. Okay? That's absolutely not the way my trend following system uses this Bollinger Band. Okay, so I will explain that in a few seconds. So here is the simple long only trend following system. Okay, for here I have focused on ES and NQ, which are S&P 500 futures and Nasdaq futures, and you can adapt that to whatever index you want. So the setup is the Bollinger Bands to go up. Here is, for example, the kind of parameters you can have on TradingView. The length here represents the period of the moving average. Okay. SMA as simple moving average, and standard deviation set to 1. And of course, that's the close of the candle that counts. Okay. So the entry signal is when we close above the Bollinger upper band. And the stop loss is set, okay, at this specific time at the lower band price. The backtest session in a few seconds will show you some examples. And the exit signal is when we close below the lower Bollinger band with the same parameters. Perfect. So now let's have a look at a quick backtest session. Okay, so now let's go. We are at Thursday, 5th of October, 2023. Let's go and let's see what it brings. Okay, Bollinger Band is forming. Okay, I have here, as you can see, a close above the upper Bollinger Band here, okay? And we can see here how is the orange line. So going here, you can see the value of your bands here, okay? The basis band is the 21-day simple moving average, and you can see that it's not going up here. So this is not a valid entry. I will text that. Not valid entry as SMA is not going up. Okay. I hope you understood that because it's really important and it's part of the strategy. Okay, I don't know where I can get an arrow. So this is not a valid entry. Okay, let's continue. Okay, still not. Still not. Not a valid entry. Okay, we continue down. Okay, huge drop. We continue, we don't care. I'm just want. Where are we going? I don't know. Okay, we are going down. I don't care. I'm not at any position here. Okay. Okay. Here. Oops, that's quite big. I will lower this. Okay, 14. That's fine. Here, what do we got? We have a close above. Fine. We have SMA going up here. Okay, you can verify that. That's okay. So what I'm doing now, I'm just entering here at the close and I'm setting my stop loss to here. And if you want to know how much you can buy according to your risk, if I write risk, I don't know, $100, let's say, 1,000 for the purpose of the calculation. My amount of shares purchased is my risk divided by entry price minus stop loss price. Here it's 1,000. The entry price, we got it, it's this one. And the stop loss price, we have it also, this one. And I just asking my calculator what is this ratio worth. And it's 1.16 shares. And because you might be doing this via, we'll say, CFDs or everything, you can buy partials, okay, up to, I think, 0.01 shares. So that's the amount of shares you could buy with risking $1,000. So let's go. Now, I don't care about the upper target. What is the outcome? Either we are getting stopped here, either we are getting stopped because we close below the lower blue band. So let's continue and have a look. Okay, don't care. It seems like we are going up. That's cool. Just a remark here, people here would have said, okay, we are reaching the upper band of Bollinger Band. Please sell, it's overbought. Guys, markets have been overbought for the past 20 years, okay? So stop saying it's overbought. It's never overbought enough, okay? It's always going up. Here is overbought. Look at what the market is going, okay? It's absolutely crazy. So let's continue until our exiting value is reached. So you can see the lower band going up also, okay? It's normal because price goes up, goes up, goes up, goes up, goes up, okay, okay. Oh, do I close here? The answer is not, because I don't have a close candle, okay, below this specific level. I don't close here. I don't care about this. Let's continue. Okay, so you can see that we are already having a nice here ride. That's fun. Let's continue to see where we go. I don't close. We'll continue. Oh, again, look at that. It's overbought. It's overbought each time. Yeah, maybe. Okay, you are right. Here, after reaching that, after being overbought here, we pushed this way and then came a bit down, but we are still very, very in the upwards trend. So let's continue. No. still going up. That's completely crazy. So, and today, that's February 12th, okay? And we are still up in this position, okay? So the stop loss now is here, okay? So I'm already risk 0 from this point. I can highlight that if you want. Since we'll say there, I'm close to risk free, because if we were closing here below, okay, I will have a small loss. So here my stop loss is now at this specific point, and it will change if market continues to go up. That's the stop loss line. Again, it's not a stop loss line, it's a stop loss level, because reminder that I need, sorry, up text, I'm going to set that to green. Stop loss indicative level. Indicative because if here I breach this level but I don't close below the blue line, I don't care about this specific sweep the week we could see, okay? So that's what trend following is about in a few examples. Okay, after this backtest session, we can finally compare overall results. Now you understood how the strategy works. So the reference graph is the classical buy and hold with an initial capital of $1,000. So why 1,000? Because when backtesting, you may, that's a recommendation, use large numbers so you could continually take trades and you don't get, I will say, wrecked because of a lack of capital. The idea is to see what the system would have done in the past. Okay. Perfect. And the TradeWin graph, okay, it's called in the legend TradeWin closed, I guess, in the following graphs. That's the same. I have $1,000 as an initial capital, but I will be risking a percentage of this overall capital that might grow over time, okay, per trade. That's a different way to deal with position sizing. In the first here buy and hold strategy, I don't have any position sizing, I just go all in. In the second here examples, and any trading strategy needs a real precise position sizing strategy. I'm risking here 7% per trade on ES and 3% on NQ. Why did I choose those percentages? The idea was to find a percentage where we could compare easily the buy and hold strategy and the trend following performance. Okay, so let's go with this ES chart from 2009 to late 2023. Okay, as I said, I chose the 7% risk per trade in order to mimic the performance of the S&P 500 index. So here the orange line represents what your equity would have been if doing buy and hold, meaning at the beginning here we purchase as much as we can from our initial $100,000 initial buying power, I will say, okay, and just hold it forever. That will have been the variations in orange, okay, and in blue you can see the performance of the TradeWin simple trend following system. So the first thing is that you can see that there are much fewer points. We have here less than 100 trades performed over the last 15 years. And that's normal. Trend following system have, I would say, don't trade so often. Okay. So this graph will help us understand many important characteristics of a trend following system. The first thing I want you to understand is that when markets do nothing, when markets go sideways, a trend following strategy would only take consecutive losses and small losses. That's how it works. Okay, so here when markets does nothing during like more than 1 year, mainly 2 years here, or even here, okay, we can see a downturn. We can see, the overall performance going down a bit, and that's normal. Okay, that's the way trend following system works. The second thing is that when markets make huge drops, as the one we had during the COVID crisis, okay, like a more than 30% drop in some days, the strategy stops taking entries. Okay, it might take at the beginning a little bad entry, but after that it will stop. And that's what it's meant to. It's to protect your capital during down markets. Okay, so here the strategy protected us during the COVID crisis. Okay, even if the price is going up quite quickly and reaching all-time highs again, we have just protected our capital from a huge downturn. And that's what you would expect from a quite performing strategy. Okay. And the last is that when markets slowly drop, as we had since beginning of 2022, strategy takes small losses, smaller losses than the index. Okay. So here again, a 30% drop. We had here only a 15% ones. Okay. That's those key characteristics I want you to remember after this video. Okay, that's really important. So that was for ES. Okay, but let's have a look at what Nasdaq is doing. And with Nasdaq, the example, if we go back to 2000, where we are here at the top of the tech bubble, it's much more appealing. Okay, what if you were just entering here, and that's just luck, my data starts here, because if not, we wouldn't have been able to have a look at this really important characteristic, that we might take some losses, okay, but never will take this huge 82% drop during the tech bubble crash. Okay, so again, if you have a look at what we did from the beginning, here we bought as much as we could of the Nasdaq shares, okay? And we don't have luck, we had bad timing, that's a risk of buy and hold strategy, and you just saw of everything going down, being crushed, and you would have waited more than 17 years to get back to break even. That's not acceptable from an investor point of view, okay? And even if you say, yeah, I don't care, no, I assure you that you care about an 80% drop in your capital, and that you are not waiting 17 years to get back to break even, okay? So again, what's the idea here is to trade the same strategy we see previously for ES with a 3% trade, 3% risk per trade. And we can see that we finally break even here sooner than the buy and hold strategy. We break even sooner, and the drop is much less impressive than what we would have witnessed during a simple buy and hold strategy. So that's the first thing. Okay, you can see that here we stop taking entries. Again, that's really important, as we are only a long-only trend following system. Again, same thing that before, we don't take entries during huge crashes. That's the COVID one. This is the 2018 one, okay? We don't have here any entries during those times. That's really important. and when market slowly drop, again, we drop, but lower, I will say, in a reduced way. That's the idea. And at the end, we reach absolutely the same profits. So why wouldn't you trade those trend following strategies? They are simple, yes. They won't make you rich tomorrow, but do that during 20 years and I assure you that you'll be rich. Okay, that's simple. That's what trend following is about. You need to come back to what is logical, what are true expectations, realistic expectations when trading. Okay, here we made what? Times 4. Okay, and from the lows here, yeah, times 8, times 9. More than that, much more than that. Okay, but that's what the strategy is about. Okay, and I'm really happy I could have showed you this impact of this tech bubble burst, because we might be in a similar bubble today. So don't go all in Nasdaq index, please. And the final graph I want to show you, and what if we just do 4% trades per 4% risk per trade? Same strategy, same everything. We just easily outperform the Nasdaq since the beginning. So what you have to keep in mind is that when we are trading trend following systems, we take bigger positions than when you day trade, because you expect your position to hold for several days, weeks. Okay, so you can afford to take, I will say, a bigger position size. And taking 4% in the Nasdaq doesn't seem completely irrelevant for me in a huge portfolio you will be able to manage. Okay, so that's the final graph I wanted to show you. General conclusions, I want you to remember that when exiting this video, win rates might be around 30% for trend following system. In my strat here I shared with you the win rate was much more, about 47, 50%, and that's huge. Okay, and the principle is that winners, because you let them run, are I would say bigger than the losses you might take. So principal idea of the strategy is that you win when markets go up, you lose a bit when markets go sideways, and you lose when markets go down, but still avoiding the buy and hold like risk. Again, I said that previously, every serious portfolio manager in the world incorporates some of these trend following strats diversified into multiple markets into account. That's what professionals do. Why don't you do that? So instead of buying mutual funds or dollar cost averaging on either doing buy and hold, I assure you that doing what I just told you in this video isn't like an impossible thing to do, only requires 5 minutes daily to have a look at the graphs. Okay, it's not like a professional skill needed, and you might adapt that to your risk tolerance to make that work for you. That's all I wanted to share with you guys. Thank you again, and see you soon for my all-weather trading journey. Have a good day and see you soon.